Hello and welcome. You're watching Business Today Television. I'm Sakshi Patra and this is a special edition on the earnings front. The company on our radar is DCB Bank. Remember, the company has reported strong set of earnings. In Q2, we've seen the profits jump by 23% to 155 crores. This is on a year-on-year basis. What we've also seen is that the NII has gone up by about 7% at 509 crores on a year-on-year basis. Also, the gross NPAs have slightly moderated to 3.29%. The net NPA at 1.17% is slightly steady. Advances growth have been about 19% on a year-on-year basis, and we've also seen that the deposits growth has come up by 20% on a year-on-year basis. Let's get into a discussion with the top management of the bank to understand what has worked well for them in this quarter and what's the outlook like. I have with us Mr. Praveen Kutty, the MD and the CEO of DCB Bank, now joining right in. Warm welcome to you, sir, and season's greetings to you. We wish you that you, your loved ones and all your team members at DCB Bank have a fantastic Diwali upcoming. Let me start off by also congratulating you for the strong set of earnings that you've reported. Tell us, how have you assessed the earnings and what has really led to the strong performance this time?
Thank you, Sakshi, and wish you and your team the same. Yeah, it's been a decent performance from our side. What's particularly heartening to note is that in times that are not particularly serene or tranquil, the trajectory has been good, 19% plus, both on the deposit side and the advances side. That's something which we are happy about. And the good news about this growth is that the growth has come despite us going cautious on the microfinance lending that we do, albeit of a small scale. On the deposit side, we have ensured that the top 20 ratio remains normal. So it meets the kind of right parameters. And then the trajectory is continuing to hold good at 19-20%, which we have always predicted. That's something which is pretty decent. On the NIM is, we would like to be higher than where it is currently. I think this is the bottom point, and hopefully we'll see a bit of a uptick on the NIM going forward. The fee performance has been very strong. There's been some windfall gains on this, one-offs on this, but even discounting that, it's been a steady, consistent fee income growth that we have seen over the last 4 or 5 quarters. We're very comfortable with the performance from a credit cost perspective at 27 bips. The model seems to suggest that we will be stabilizing around 35 bips, but comfortable on the NPA front, specifically with recovery. While our fresh flows are slightly elevated, our recovery percentage is 83%. So all in all, ticking multiple boxes, some work to be done on the NIM, and definitely some productivity improvements to be done on the OPEX front.
Okay. Do tell us how better can the numbers get from here in the second half as well as the next fiscal year as well. Why I'm asking this is also because there is a slight contraction in the net interest margins in Q2 is what I've seen. So if you could highlight on that factor too.
On the NIM contraction, there has been some one-off hits on the interest yield. There has been some structural movement from penal interest to penal charges, which would continue in the future also. As a bank, like I mentioned earlier, we kind of foresaw early the MFI challenges and had reduced and curbed lending of MFI, which has resulted in high yield potential high yield loans being substituted with secured lending of a lower yield. And lastly, our own organic growth of loans, I would expect it to be a bit better. Instead of that, we had some higher co-lending going forward. So once a higher uptick happening on our organic lending comes through, the one-off issues we had are a thing of the past. You would see the NIM getting better. And from a cost of funds perspective and a cost of deposit perspective, what clearly comes across is that it's stabilized. Actually, in this quarter, there has been a 2 bips reduction on the cost of deposits, and we'd expect it to remain range bound, stabilized at this particular level itself.
Okay. Also, if you could highlight about the loan growth, which was strong already, 20% year on year, which are the segments that have actually led to this credit growth and credit offtake, and what is your target for loan growth for FY25?
We'd be happy with a 20% growth year after year in the chosen segment. Mortgage is a chosen segment. Gold loan is a chosen segment. A key SME is a lifeblood, is a pretty much the DNA of who we lend to. Construction finance is an area of interest to us, which we are growing. Effectively, small ticket, retail, secured. That's where our comfort level is, and that's probably where we'll continue to grow also for the foreseeable future.
Okay. Let's talk about the slippages which have been elevated at 3.7%. If you could detail for us any one or two reasons that have been behind it. And are there any fresh concerns or asset quality?
On the slippages at 3.7%, the primary culprit there is gold loan, where we find uh, educating people on the discipline of repayment is a bit of a problem. We're putting our vernacular videos, multiple things to ensure that the discipline is built in. A lot of
Sure.
our gold loan customers are coming in from the unorganized financing market, so that's a bit of a challenge. It's been a challenge considerably for some long time now. But what is really heartening for us is the recovery, which you see upgrade and recovery at 83% is something which we are pretty much comfortable with. But yeah, given a choice, we have some work to ensure that the slippage in the gold loan as well as the non-gold loan market is a bit curbed going forward.
Okay. Do also tell us on the credit to deposit ratio, where does it stand currently, sir? And also, if you could highlight what measures are you really taking to boost the CASA levels currently?
Right. So on the CD ratio, the bank is in the early 80s from a CD ratio perspective. What we've seen, what is demonstrated over the past multiple quarters consistently, is that on a higher base, we grow liabilities more than we grow loans. So even in this particular quarter, if you would see, our deposit growth rate has been slightly higher on a higher base as compared to the loan growth, both in the 90s, but you would see that the liability growth is slightly higher, and that's been the way for the last 4 5 quarters and even before. So it's a fundamental philosophy of the bank that deposits comes first and loans come later. So very, very clearly, because of this, you'll find that the CD ratio is consistently coming down, and we possibly would see this continuing to happen in the future as well.
Okay, and how is the festive demand really shaping up for you? You did point out about gold loans. So at sky high prices and record high levels, are you seeing higher demand for that too? And also going forward, once the interest rate cuts start to happen, what is the kind of things that you anticipate going forward on the loans front?
On the loans front, this is a Diwali season. You would find an uptick happening in the market anyway. Consumption, and as a pattern, what we're seeing is that there is a shift from from savings to consumption happening, specifically
Yeah.
in the younger set of generation. That's fairly visible for all of us. So I would tend to think that the loan uptick would be higher going forward. Uh, there is mortgage is a big piece in our set of products that we offer. The mortgage demand is still continuing to be uh, uh, to improve. Gold loans is another area where we see continued demand coming in. So pretty much we would in the chosen areas we would see continuation of the demand coming through, and there is enough to select and pick. There is enough in our market from our size to grow sensibly at near 20% year on year.
Okay, well, all the very best to you for the upcoming quarter, sir. And thank you so much for sparing your time to explain to us what has gone in this quarter. And here's once again wishing you the best of festivities ahead. And here's hoping to see you once again after the festivities are done around the next quarter. Thank you so much.
Look forward. Thank you so much.
All right, with that, viewers, we'll wrap it up on that note on DCB Bank. You heard it from the top management. What have been the key contributing factors for the strong performance this time around? The expectations going forward, the key factors that can continue to drive growth for the company on the top line and the bottom line as well. Many thanks for being with us on this edition, but do stay tuned. A lot is lined up for you on Business Today Television right after this too.
First of all, let me take opportunity on behalf of ATGL. I wish a very happy and prosperous festive season to all our viewers, consumers and shareholders. I am pleased to share the operational and infrastructural result of Adani Total Gas for the quarter ending September 30th, 2024. During the quarter, our overall volume rose by 15% on year-on-year basis. This double-digit increase is on account of our network expansion, coupled with increase in consumption of PNG by commercial and industrial consumers due to stabilization of our gas prices. Our CNG network has increased to 577 stations, which includes 113 Dodo